The stock market is a powerful force. It can create wealth and crush dreams with equal ease. Right now, there's a big question hanging over Wall Street. Is a crash coming? It's a question that keeps investors up at night. No one has a crystal ball, but we can look at the signs, the data, and the expert opinions. We're living in uncertain times. Inflation is still a concern, interest rates are rising, and the world is on edge. All of these factors can impact the stock market in a big way. But here's the thing about the market. It's driven by fear and greed. When fear takes over, a crash can happen. When greed is in control, the market soars. So, buckle up. We're going to dive deep into the factors that could cause a crash and what you can do to protect yourself. Let's talk about valuations. Some experts argue that the stock market is overvalued. They point to high price-to-earnings ratios, especially in the tech sector. A high PE ratio can signal that a stock's price is too high relative to its earnings. We've also seen a narrow market rally. What does that mean? It means that a small group of stocks, mainly tech giants, have been driving the market higher. This narrow leadership can be a warning sign. If those few stocks stumble, the whole market could fall. Don't get me wrong, the economy has been resilient, but there are cracks in the foundation. Inflation is stickier than we thought. The Federal Reserve is still raising interest rates, and consumer confidence is shaky. The big question is, how long can this bull market last? The Federal Reserve, or the Fed, plays a huge role in the economy and the stock market. When the Fed raises interest rates, it becomes more expensive for companies to borrow money. This can slow down economic growth and impact corporate profits. Higher interest rates also make bonds more attractive to investors. Why? Because bonds offer a fixed return, unlike stocks, which are inherently riskier. So, when interest rates rise, money can flow out of stocks and into bonds. Right now, the Fed is in a tough spot. They're trying to fight inflation without causing a recession. It's a delicate balancing act. And their actions have a direct impact on your portfolio. Investors are watching the Fed's every move. When the Fed speaks, the market listens and reacts. Those who cannot remember the past are condemned to repeat it. We've seen market crashes before. The Great Depression, the dot-com bubble, the 2008 financial crisis. These events are etched in our collective memory. What caused these crashes? A combination of factors: excessive speculation, loose monetary policy, overvaluation, and systemic risks. In each case, the market climbed to unsustainable heights before crashing down to earth. But here's the thing. History doesn't repeat itself exactly. Each crash is unique. However, by studying past crashes, we can identify patterns, understand the warning signs, and learn from the mistakes that were made. The key takeaway? Don't let greed cloud your judgment. Be aware of the risks. Section 5, Tech Titans and Market Concentration, a House of Cards. The tech sector has been on fire in recent years. Companies like Apple, Microsoft, Amazon, Google, and Facebook have grown into behemoths, with valuations in the trillions of dollars. They've dominated the stock market and driven much of the recent bull run. But this concentration of power in a few companies worries some experts. They argue that it creates systemic risk. If one of these tech giants stumbles, it could have a ripple effect throughout the entire market. Remember, even the mightiest companies can fall. Think of Nokia, BlackBerry, or Blockbuster. They were once giants in their industries, but they failed to adapt to changing times. The tech landscape is constantly evolving. New technologies emerge, disrupt industries, and reshape the market. The question is, can today's tech titans stay ahead of the curve? Section 6, the global stage, geopolitics, and economic uncertainty. We live in an interconnected world. What happens in one part of the globe can impact the entire global economy. And right now, there's a lot happening on the world stage. Geopolitical tensions are rising. The war in Ukraine, China's growing assertiveness, and political instability in many regions are creating uncertainty and volatility. Economic challenges are also mounting. Inflation is a global problem, supply chains are still disrupted, and energy prices remain volatile. All of these factors can impact the stock market. When investors are uncertain about the future, they tend to become more risk-averse. This can lead to selling pressure and market declines. The global landscape is complex and constantly evolving. Investors need to stay informed about global events and understand how they might impact their portfolios. Section 7. Shielding your portfolio, strategies for uncertain times. So, what can you do to protect yourself in this uncertain market environment? First and foremost, don't panic. Remember, market downturns are a normal part of the economic cycle. Here are some strategies to consider. Diversification. Don't put all your eggs in one basket. Spread your investments across different asset classes, sectors, and geographies. Profit-taking. If you've made significant gains in your portfolio, consider taking some profits off the table. This can help you lock in your gains and reduce your overall risk. Risk monitoring. Regularly review your portfolio and assess your risk tolerance. Make adjustments as needed based on your financial goals and market conditions. Cash is king. Having some cash on hand gives you flexibility. You can use it to buy stocks during market dips or cover unexpected expenses. Remember, investing is a marathon, not a sprint. Stay focused on your long-term goals and don't let short-term market fluctuations derail your plans. Section 8. Riding the roller coaster. The importance of a long-term view. The stock market is like a roller coaster. There are ups and downs, twists and turns. It can be an exhilarating ride, but it can also be scary. The key is to stay calm and focus on the long term. Don't make rash decisions based on short-term market movements. Remember, the market has always recovered from downturns, even the most severe ones. When the market falls, it can be tempting to sell everything and run for the hills. But that's often the worst thing you can do. Selling at a loss locks in your losses. Instead, view market downturns as opportunities to buy quality assets at discounted prices. Investing is a long game. Stay patient, stay disciplined, and stay the course. Section 9. The final word. Stay informed, stay calm, stay invested. The truth is, no one knows for sure if a stock market crash is coming. There are a lot of factors at play, and the market is notoriously difficult to predict. The best thing you can do is stay informed about market conditions, manage your risk, and stay focused on your long-term financial goals. Don't let fear or greed dictate your investment decisions. Remember, the stock market is a powerful tool for building wealth. By staying invested and weathering the inevitable storms, you can participate in the long-term growth potential of the market. Stay informed, stay calm, and stay invested.